Platform I've never been on before. So
Okay, no worries. Here you go. Hello, everyone. Thanks for joining our LinkedIn Live of Startup Game Changer. Today, we are going to talk about what investors are looking into a pitch deck or into a founder to do investment in them. I have a guest, Jerry Hykins. Jerry is a very famous name and face here in Southern California startup ecosystem and angel and investor ecosystem. Jerry, welcome to the show, and please go ahead and introduce yourself.
thank you. Good morning, everyone. And Anshuman is embellishing a little bit, I think, but thank you, my friend. My name is Jerry Hykins. I've been here in Southern California now for 6 years. Uh, been entrenched in the ecosystem, doing business development for small venture capital firm, sourcing deal flow, building investor relationships out here. And last 3.5 years, I've been executive director of Thai SoCal and Thai SoCal Angels. And now I'm currently raising a venture fund focused on what we are referring to, my business partner and I referring to as overlooked and underestimated founders, uh, specifically having a strong focus on minority and diverse founders. And we are in the process of raising that fund. So happy to be here and impart any kind of knowledge. And I've seen thousands of decks now over a number of years, and mentoring a couple startups right now as far as their deck and how they interact and build relationships with investors. So, kind of my specialty is building relationships with investors because it is a bottom line, it's a relationship game. So,
Thank you so much, Jerry. So, as you know, the topic is how investors evaluate startups for funding, and I have identified 10 pointers, and we only have 30 minutes or now 28 minutes, so we will go very fast on that. So, we are going to talk about the market opportunity, the problem and solution, team, traction, business model, competitive landscape, financials, exit strategy, risk assessment, and alignment with investor goal. As you mentioned, you have reviewed thousands and thousands of pitch decks. I have done the same, and both are part of various ecosystem related to investors. In fact, Startup Steroid, my company that I co-founded with Asis Sabu, have a platform for startup founders to apply to get in front of investors. And then we have a demo day platform and a SPV platform. So let's talk about the market opportunity. When a startup founders reaches out to an investor, the market opportunity is the big thing. What is your take on that? I would like you to comment on market size, growth potential, trends, and timing, because I feel within the market, opportunity, these are the three things which are very, very important. One is the market size, your growth potential, and then the trends and timing. Timing is everything. So, Jerry, your views, real quick.
well, yeah, real quick because we got a lot to cover. The market, Tam, Sam, and Sam, which hopefully everyone should be familiar with and are familiar with, are one thing, and we want to know. We usually know how big a market's going to be, but the challenge is have you validated that market? So when it comes to the market, have you gone out and done your research up and above going to Statista and it telling you this is how big your market is? Have you interviewed potential customers? Have you done customer and market validation to show that there is actual a need for your product or service that you're offering? And the challenge is, and this kind of touches upon market, is that every startup, and I just got an article actually from one that said they're the first date cola out of Saudi Arabia. It was a big press release, and it's kind of like, well, no, there's a number of other date sodas that are on the market, so why are you claiming to be the first? So you have to be real careful about being the first. The ability to execute is what's going to help your growth, and having the actual market and customer validation. So don't assume that because you're the only idea that you're finding, maybe when you do a quick Google search, there's a lot of other companies that are flying under the radar. And the market has to be big, but you have to be doing something very different and unique to the market that in just one little thing necessarily isn't going to do it. You have to have something that's going to be a market changer. And that way, that right now the trend obviously is AI, but that's also that's a big opportunity. But at the same time, everybody now is jumping on board and saying they're doing AI. So are you
Right.
actually, as an AI company, are you developing a language model utilizing AI, or are you just piggybacking off an existing AI and leveraging Chat GPT, which, last night Anshuman and I are both at the same event, and some of the companies, all they were doing is utilizing Chat GPT, and anybody can actually just go online and pop online and utilize Chat GPT and get the same information. So that's just real quick because I know we have a lot to cover here.
Yeah. Yeah, thanks, Jerry, on that. So, for the benefit of our attendees, I would like to summarize that market size is the market large enough to support significant growth? The growth potential is, does the market have the capacity to expand in the coming years? And trends and timing is the startup entering the market at the right time, considering industry trends and customer demand? AI is a very good example of that. So now let's move to the second point, which is why you are building this startup. What is the problem and solution? And I would like to talk about pain point, solution fit, and USP, the unique selling proposition. So Jerry, go ahead. Pain point in a problem and solution for a startup.
Well, it needs to be a big enough problem that people are going to be interested in what you're doing, and what may be a big problem to you personally may not be a big problem to other people. But it needs to be. That's where again the market research comes into play, and the validation is to know that your pain point, because usually you're starting a company because you have a passion, or there needs to be a why, and a why is part of that problem solution that you're coming up with. Why are you doing what you're doing, and is it big enough problem? For me, if somebody is needing to take 5-10 minutes to explain the problem, then either it's not a big enough problem, or it's too difficult of a problem to understand, or it's just uh, you know, if it's a big problem, it should be pretty easy to understand. So a lot of startups kind of get into the weeds of spending too much time on the here's the problem, and the solution is really simple to really display. Is to show me how it works. Uh, if you have an app, even just take screenshots of here's the steps that one of our customers will go through to make it to get to the solution and have it work. And the pain points are important, because if there's no pain, then there's no advantage. There's no the reaping the rewards afterwards. So you have to have that pain point. What was the third thing you said, Anshuman?
The USP, the unique selling proposition.
Oh yeah, the unique selling proposition again, and I touched upon that initially on my first comment, is that when Arabian, my partner, and I have a talk with people, and I know he talks about, it's like, what are you really doing that's different and unique? Sure, you're throwing in a little something that might be different, but we're looking for big, unique selling propositions. We're looking for something that's going to be more, and I hate using the term disruptive. I don't think it's being as used much now, but it's kind of the term that always has stuck in my head when I first entered the ecosystem, the disruptive thing. But is it going to make a big, significant difference in the market and change the market? And that's what we're looking for.
Yeah, absolutely. So once again, for the benefit of our attendees, problem and solution, pain point, does the startup address the genuine and significant problem in the market? Don't try to solve your own personal problem that you have had in your previous life. It has to be a general problem that is going to help a lot of customers if you bring a solution for that. The solution fit is the product services a compelling solution to this problem? Are you solving the whole problem or just a bit of that? You need to be very careful about that. And then the unique selling proposition, or the USP, is what sets the startup apart from the existing solution. So like when Zoom came in, there were other video conferencing thing available. So what did Zoom did to set them apart? So you have to figure that out very, very early on before putting in a lot of cash and time in the startup. So we have already spent 10 minutes. So, let's go fast. The third point is team. How do you view the experience, the resilience, and the commitment of the team members? What is your view on that? The experience of the team members for trying that solution or identifying that problem and then trying to find a solution for that. Jerry, go ahead.
Yeah, and these are all topics that take so long to delve into each of them, especially team, because team, it depends on where you're at with the company. If you're a brand new startup, and a solo entrepreneur and don't have a team, then that can be a challenge, especially if you're out trying to raise capital, because an investor doesn't want to invest in a solo entrepreneur. They want to see somebody who has a team put together. So if you don't have the capital or the connections to have a chief marketing officer, you typically, the founder is going to be the CEO, even if they're have the technical background. And if you're doing something technical, which most are, then you need a CTO. And so it gets to be a little bit of a challenge. So you have to seek out advisors, people that are influencers, mentors, whoever it might be in your life, that you can bring on board just to help advise, so that we see that there's an advisory team behind what you're doing. Uh, your background and credibility in an area is important. As an investor is looking at the team, they want to know that you have the knowledge. And if you're a technical person and have no business background, but you're the CEO, that's a red flag, because they want somebody who knows the business to run the business side of it. So I'm just trying to think of some quick pointers off the top
Yeah.
that are important. And building your co-founding team and your just general employee team, it takes time, because you have to build a trust. It's a relationship, especially with co-founders. It's like a marriage, and you can't just randomly go, well, this person's pretty cool, they know the tech side, I'm going to bring them on board as a CTO. You have to do a trial vetting out period. You have to spend time with them. You have to, what I call, break bread with them and make sure that you're on the same page, because we hear horror stories of co-founder, issues all the time. So
Yeah.
just my
So
quick.
once again, yeah, Jerry, once again, I would like to summarize it. The experience of the team members become very, very important. Do the founders and the team members have relevant experience and a strong track record? And the track record might not be that, you are a serial entrepreneur. The track record can be established by various other means, like, your educational background, how far you are already in your startup, like, have you created the MVP or not? Commitment is very, very important. Are all the co-founders committed to the startup? If you're doing your day job, to meet your monthly expenses, and then trying to do the startup on the side, the chances are that none of the serious investors are going to fund you. You may be able to raise some friends and family round, but after that, when you are going to angel investors, you have to have both your feet in the same boat. You cannot be riding two horses. So please make sure of that. And now let's talk about traction, revenue and customer growth matrices, and proof of concept. So how important for investor when they are evaluating startups for funding is traction, divided into three parts: revenue and customers, growth matrices, and the proof of concept, Jerry.
Uh, so it's extremely important. As Anshuman and both and I are aware, we've attended the Angel Capital Association conferences for a few years now, and the whole message, even through angels, is they're not investing in companies that are, for the most part, not everyone, but for the most part, they're not investing in companies that aren't in revenue and showing revenue is some serious revenue growth. Paul, the co-founder uh, she's Y Combinator. Jeez, I had a little brain fart there. Excuse me. All Y Combinator said that typically they want to see 5 to 7% weekly growth. And if you're doing 10%, that's fantastic and great. But you want to be seeing that type of growth so that we know that the company is growing and building as far as the revenue growth goes. And traction is just I I see so many decks where people are putting on their, we won this award, we won this pitch competition. That's not traction. Please do not put that on your traction page. Traction is having customers, traction is having whether it's LOIs, partnerships that are helping you build your company. And what was the third thing on
And proof of concept.
proof of concept? Well, yeah, the proof of concept, you have to show what you have works. I mean, so that means you have customers that are using it, you have positive feedback. If you have customers utilizing your product or service, you need to have data that backs up their experience, the customer experience. So you need to collect, you need to do survey polls with all of those that are utilizing your product. And I've seen on traction pages where people will have uh, like two or three quotes, testimonies. Testimonies are fine, but unless it's a testimony coming from like the CEO of Microsoft or the CTO of a Google or something like that, putting on a couple, they could be your mom, they could be your brother, they could be a friend who's just writing up a testimony. We want to see the data. Numbers
Yeah.
are and data are important for proof of concept, and that what
Yeah.
you're doing is working.
Thank you, Jerry. So once again, to summarize, traction in revenue and customer are these early signs of market acceptance. Do you have paying customers or partnership? So that will define your customers and the revenue. Are you making some revenue or not? The growth details are what is the startup rate of growth in terms of user revenue, market share, month over month, week over week. It has to go on a upward thing. You cannot go like this, then become a plateau, and then dip a little, and then try to again do it. If you are a really good startup, and these things could happen, but then you have to have a very good storyline for that. That why it impacted, maybe because of COVID. I don't know. What is the next downturn is going to be. So growth has to be growth, and then proof of concept is that has the startup validated the idea through pilots, prototype, MVPs, and paid pilots. If you're a tech startup and doing paid pilots, that is a very good sign and a significant confidence that is gives to the investor when they are looking to invest in you. I'll go to point number 5, which is the business model, and I will divide the business model under 3: scalability, revenue streams, and profitability potential. So, what do you think, Jerry, about business model, scalability, revenue streams, and profitability?
What was the third thing, Anshuman?
Profitability. So, scalability is that can the business grow significantly without
Yeah.
potentially increasing the cost. So, per unit cost has to keep coming down,
Yeah.
and there is a potential market where you can go and sell your product and services. So that will be the under your business model. Scalability is very, very important. That your product or service that you are giving has to be scalable. And then the revenue stream, that how many source of income you can generate from one product line.
Yeah.
Can it be a one-off sale, or is it a SaaS model? So some of your views on that real
Yeah,
quick,
yeah. I
Jerry, and then
mean, and obviously, right now, SaaS is so popular out there because it's a recurring source of revenue, and you can break it down into whether it's monthly or uh, biannual or annual, and you can have regular freemium, premium. You can have whether if it can be a platform where you're selling B2B, where you can have the enterprise solution. You can like one startup last night just came at the top of my head. Their business model, their whole pitch was focused on personal branding. And we want to take small companies and help them brand their small companies without having to go through the whole influencer thing and all of that. But when it came to their business model, the business model had it was like, I think it was like $15 a month for the personal branding package. And then they had a corporate package for like 150, and then they had an enterprise package. And it's like the revenue models didn't match what their problem and solution was. The problem and solution was geared towards the small business owner, but yet their business revenue model was geared more towards the larger, medium, and enterprise scale businesses. So there was a big disconnect there. But with it, the scalability is so important because as you're growing, your cost actually should, especially if it's technology and a tech platform, your cost should go down technically your customer acquisition costs as you're marketing and as you're becoming more efficient, and even especially in the hardware, the CPG space, the more production you're doing, you should be able to bring your costs down. So it's very important for scalability that you can get out there and, Arabian always says, my partner, can you take it viral? And taking something viral is will show you how scalable you are, because you've seen some companies that can take something viral and they can get millions of views within the first month or two. He took a product to they raised through a crowdfunding campaign. They raised like $1.5 million in like less than a week because he took it viral through social media. So it all depends on what you have for a product and service, because again, it's going to be a little different between CPG and tech, but it all works the same way. You want to bring down, the more efficient you are, your cost should go down and your scalability should go up.
Yeah, thank you so much, Jerry, for that. So again, for the benefit of our attendees, business under your business model, there has to be 3 points that you must address before going in front of an investor: is scalability, revenue stream, and then profitability potential. That how soon you are going to be profitable and ahead of the curve. So that is very, very important. I know, Jerry, you have a bad throat today, so I'm going to take the next one, which is the competitive landscape. And under competitive landscape, startup founders, you have to look at competition, you have to look at barrier of entry, and you have to look at the differentiation of your product. So, what is competition? Who is your main competition, and how does your startup compare against those competition? If in the market there is competition, it is a good thing, because that tells the investors that the market is qualified and the problem is qualified. So if you are coming up with an innovative solution, the chances are very, very high that you will get funding, because there is already competition which validates the market. So that is a very good point. Barrier to entry: what you are doing which is so unique that you have competitive advantage that nobody else has. So what prevents others from copying your business model is very, very important. So whenever you are building your problem solution, it has to be created in a way that nobody can copy you. And trust me, just getting a trademark is not that. If you are getting a trademark, people are going to copy you, and then you need to have at least $1 million to fight that trademark issue, or patent issue. So don't go for patent and those things if you're doing it very, very early. But try to create something so unique that the barrier of entry is there, and then the differentiation. How does the startup maintain the competitive edge? That is very, very important. When we started Startup Steroid, it is a deal flow platform. We are trying to make a platform where startup founders meet with investors. But then 1 year down the line, when we are selling our product, suddenly AI is so big. So right now we have a dedicated team of professionals just working on AI solution on our platform. Like, can we rate the companies looking at the market data and give them a investable score? So my team is working on that. So you have to really look at the trends and try to update your platform very, very quickly, so that investors line up to you to get the early advantage. So now let's talk about financials.
And if I can I say real quick,
absolutely.
Ever put in your deck that you're the first and only company doing something. Never do that. It's just a bad idea, because we're smarter than that. And even if you think you are, you don't know how many companies there are on the West Coast, East Coast, globally, that could be doing the same thing, that are flying under the radar just like you are. It's just a red flag. That just never put that in your deck. Anyway, on to financials.
Yeah, on the financials. So financials is use of funds. If you are taking money, always think of founders that the investor money is without any collateral. So they are just taking a chance on you. they are the high risk takers. So, use of funds, make it very, very clean in your pitch deck that, what are where the funds are going to be. Don't say that, I am raising $100,000 or, $1 million, but, the co-founders are going to take a $250,000 salary. If you put that kind of a funding requirement, then, the chances are that, you will not get the funding from the startup. The second one is burn rate. Burn rate is how much money the startup is making and what is your total cost, and what is that delta which is not being met by the revenue that the company is making. That is what burn rate is. So try to keep the burn rate very, very minimal. How much money is the startup spending relative to its revenue is your burn rate. Try to keep it very, very limited, so that there is a lot of runway for you to raise funds and try to take the funding and build your product or services and acquire more customer. The third one is projections. The projections is very, very important. We have been looking at projection reports, and they are showing 400% growth. Man, the most successful unicorns don't have 400% growth year over year. So how you are going to make it? And do you understand what type of advertisement dollars and the support is needed to build that kind of a company with that kind of a growth trajectory? So be not very conservative, but at the same time be realistic in your projections. So Jerry, would you like to add something on projections?
Yeah, and I think I saw a question pop up that talked about matrix, key matrix, as far as watching how the growth of your startup, and that would be part of what you talked about, your burn rate, how you're spending capital as opposed to the capital that's coming in, and your burn rate and the fluctuation or your growth fluctuations is going to be how you need to keep an eye on the health of your startup. And again, though, it's so subjective and hard to get into all the details because it depends on where you're at. At the growth. Are you at the very early stage? Are you very pre-revenue? Are you idea stage? Do you have revenue? Are you in LOIs and contracts to start going into revenue or launch in the next month or two? So there's so many determining factors there on, to be able to answer those questions in a short period or a little difficult. But yeah, the pie chart on usage of funds is very important. And then being able to justify when it gets into deeper conversation of how those are split out. Because I saw a company recently, they're doing an AI, it's a mental health platform for the educational high school system. And they're doing their first pre-seed $4.5 million raise, which is already a red flag, because you're not going to be doing a $4.5 million pre-revenue, pre-seed raise before you've even launched your product. And 2 million of it was going into the development, which to me seemed like a red flag as well, because that didn't seem as realistic. I don't think they need to spend $2 million on that anyway. So yeah,
Jerry, we only have 2 more minutes to go. So, let me quickly cover the exit strategy.
Sure.
So for early stage founders, here is a trick, don't put the exit strategy, just put some timeline in there. Are you going to keep running the company? Are you going for IPO, or somebody will acquire you? When you are raising the angel round of funding, you have no clue how much pivot you will have to do and where the company will be 3 years, 4 years down the line. Only very few companies go from the day one to IPO, and the journey is 10 years. So how can you, identify what is going to happen after 10 years when you are raising your first check as an angel? So, don't put those things that, the exit is IPO and the IPO is going to be this big. Investors are very knowledgeable. They are going to laugh at you, but always give a timeline that, how long will it take for the investor to realize their return, and what type of return are you talking about? So, you should certainly put in that. Then, risk assessment is very, very important, comprising of market risk, execution risk, and product risk. And we can have a separate session on that, because I feel we don't have enough time for today to provide all those details. And alignment with investor goal is very, very important. So what is alignment with investor goal? Stage fit. Is this investor have you done your research? Are you going to the right investor? Because that is another challenge that I see, that many founders, they don't do any research on their investor, and they are sending their pitch deck to them. So, like Jerry said, that, he is only going to invest in underprivileged founders. So, if you are a founder coming from a great pedigree, you might not be the right fit for Jerry's, hypothesis of who to invest in. So, always find out that, who is an agri-tech investor. If you have an agri-tech company, angel group, which has never invested in agri-tech, even if your company is solid, they are not going to change their business model because they don't understand that market. So be very careful, do some research on your investor, that what they do, which is called the sector focus. Are you doing something in EV, and are you talking to EV investors? And those segmentation can be found through a simple LinkedIn search and some of the other searches. And then there has to be a cultural fit. If you are a founder from India, and then you are trying to pitch to an American investor with no cultural connection, many a times they are not even going to talk to you. That always happens. We get so many pitch decks from Europe, but our market is not Europe. We don't understand that geopolitical situation there. We don't understand the market there. So even the company is very, very good, I'm not going to invest in there. So with that, we come to an end today. We will be bringing such informative session. If you feel like this was informative for you, then please do loud us. This event will be again showed on LinkedIn. So give us your claps, and keep motivating us, so that we bring such type of events to you. So with that, thank you so much, Jerry, for giving your time today.
Thank
Thursday
you.
morning here in Los Angeles, and he has a bad throat today. But I'm so grateful to you, Jerry, for being with me on this show.
Thanks,
Thank you so
thanks for
much.
having me. And my brain and everything will be functioning. And I don't know, this blurred my face when I did the blur background thing too, I think. So I don't know.
Yeah, a little bit,
This
yes. But next time
platform-
you'll do it better.
yeah. Okay. Thank you all.
Okay. Take
Thank you.
care. Bye-bye.